Got a few stage surfers here. Thank you. So our next session will be a presentation from Bank Trust & Co. We have Ayodeji Dawodu, Desk Analyst and Head of Africa Coverage, Dean Tyler, Board Member and the Head of Global Markets, and Michael Pactini, Managing Director and Head of Debt Capital Markets. So we'll be starting in the next 2 minutes. Thank you.
Oh, not on our own. No, we're going to be doing it as a... Yeah, exactly, just the one slide. Thank you.
Start now, it's 15 minutes.
Sure, yep, thank you very much.
Yes, sorry.
Hi everyone, thank you for sticking with us throughout the day. I know it's been a long day, but it's been a fabulous day, I think, so far. I'm Dean Tyler, I'm the Head of Global Markets here at Bank Trust. We're a London-based investment bank focused purely on emerging markets. We've been around for 20 years, historically purely Latin America focused, but in the last 2-3 years we've really pivoted to be global, what we call global high beta emerging markets. So that's really led us to a situation where probably about 70% of what we're doing right now is actually in the senior space with a heavy link towards Africa. I've got with me Mikhail Pactini, who runs the debt capital markets in that space, and Ayodeji as well, who's based in our Lagos office and amongst other things runs our research team down there as well. Just to give you a little bit of a flavour of what we actually do. As I say, our headquarters are in London. We have a trading and sales operation as well in New York as well as London. And then we have regional headquarters in Latin America based in Buenos Aires, and we're currently in the middle of finalising construction of our regional office in Lagos as well, which is where Ayodeji is based. We trade both hard and local currency. There's some amazing opportunities right now. I mean, I don't know if you were at the last panel, but Mikhail's final comment there, I think, is exactly one of the opportunities that is out there right now. Hard currency corporates in Africa space yielding 12 to 15%, very dislocated from where we think value is right now. It's also one of the challenges in emerging markets. You've seen some of the problems with liquidity even in the UK gilt market in the last few weeks. And we even see it with in some occasions where the US Treasury market's not really functioning the way it probably should be. So you can imagine some of the liquidity issues that we have even in the hard currency markets across Africa, for example. The other potential markets that we are working into are the local currency markets, again, across Africa. It's something that we've been experienced in Latin America for many years, using Lagos as our initial hub, and with Nigeria being one of the deepest local African markets. We tend not to venture too much into South Africa as a firm. It's very well banked by a large number of South African banks, as I'm sure you're aware. But that's really left us with a good portion of the rest of the continent to look at. We really have been very surprised as well by, once again, the repetition of the mistake made by a lot of global investment banks, last seen en masse in 2008, pulling out of emerging markets, and once again we're seeing it again. Cracking examples that make no sense at all, like our Credit Suisse losing money on Archegos, pulling out of Africa to reduce risk, and similar examples, and some of the French banks now really starting to scale back as well. So again, we think it leaves a lot of opportunity for what is a UK-based investment bank, focusing purely and solely on emerging markets. So that's what we do here. I'd like to hand over to Mikhail now to talk about one of the other products that we do, which is the capital market side.
Thank you, Dean. So some of you might have listened to the previous panel. I'm running the debt capital markets for CEMEA at Bank Trust, and I want to say a few words about this space and how I see Africa and sort of opportunities and challenges for sort of debt investors and debt issuers. Maybe starting with opportunities. I see practically every investment into Africa as an ESG investment, and we talked about it at the previous panel. Practically every dollar that is invested in Africa has a tremendous sort of social impact. I would say, sort of the multiplier is much higher than in Western, than in developed countries. The second opportunity is something that I think we didn't mention before is sort of the Africa free trade area. I just hope that this initiative which has been sort of slowed down by COVID a little bit, will gain momentum going forward and will actually enable corporates to scale up relatively quickly. And that will open them for investment from institutional investors. And the third one, I would say that over the last 15 years, Africa really and African investment have found ways to get to institutional investors. So before 2007, only 2 sovereign countries out of sub-Saharan Africa issued bonds. It was Nigeria and Ivory Coast. Over the last 15 years, we have seen almost 140 billion bonds issued by sub-Saharan Africa sovereigns, which means that there is quite a lot of institutional investor recognition of Africa, and they start actually seeing differences between Nigeria and Kenya and Ivory Coast and Senegal, what sort of we didn't see a decade ago. So there has been a great improvement in that space, and though obviously that currently the markets are dislocated, I think that this institutional knowledge of the continent has improved dramatically over the last 15 years. Challenges. I think that the first challenge among issuers is governance, sort of transparency and reporting. And obviously institutional investors expect those at a very high level. And obviously we've talked before that it would be a great idea for those corporates to bring on DFIs early on board who could be a catalyst for this improvement. The second challenge is size of some of those opportunities. They are sometimes too small for institutional investors. And again, they need sometimes or often an investment from, for instance, DFI or private equity to basically scale up to make this issuer suitable for institutional investor. And the third one sort of goes a bit hand with the second one is the local equity content. There are lots of projects which require this first equity kick, and there is very often just not enough equity in the space to sort of snowball a project. So that's from my end sort of the opportunities and challenges that I see at this point in sub-Saharan Africa.
Great, thanks Mikhail. I'll just add to that in terms of opportunities, I think a lot of what is missing about the continent is the data and the insights. There's been a lot of reduction in terms of coverage there. The challenges in data are very apparent, especially on the understanding as well of policy direction and the interpretation of policy. What we try to do is we try to have a underground feel for what's going on. We try to be as close as possible to policymakers. In terms of the data side of things, what we don't have in terms of publicly available data, we try to have a good understanding of what's going on locally to a certain extent, gather the data as well. And that's how we try to help our clients to take advantage of some of the opportunities that are on ground. I'll stop there and hand over to Dean.
And just to bring to attention as well some of the other opportunities that we've realized in the last few years as well is what we call boring products to exciting clients. So as well as the exciting products such as Latin America and Africa that we bring to what we deem boring clients, i.e. European and US investors, we're finding more and more business developing relationships with local investors. So that's everything from insurance companies, pension funds, asset managers, hedge funds across Latin America, across Africa, providing them with prime brokerage services, custody services, and we're actually finalising our deposit licence here in the UK as well to become a fully fledged UK bank, again focused purely on really banking emerging market corporates and regional financial institutions. That's something that has really been led by intense offboarding from the international banks. In fact, I was talking to an ex-colleague of mine at one of the large European banks who've offboarded 1,000 clients, corporate clients across emerging markets in the last 3 months alone. So that leaves a lot of space for someone focused very much on that. And the other thing that we do is we work very closely with government both here in the UK and the US to really try and align really what they're looking to achieve in emerging markets, and whether that's a counter to Belt and Road Initiative, for example, which is, I think, something that the West has been extremely slow on the uptake. And there really needs to be a new relationship, especially in Africa, between Africa and China, I think, going forward. We're big believers that new relationship will be built very much with Chinese asset management firms, insurance companies, and pension funds, which AUM is growing extremely rapidly, rather than through another wave of Chinese government-owned bank entities and their similar investment type projects that they've carried out historically. So those boring products, and I'm talking even simple things like we're finding regional investment banks, even some central banks who are struggling to access cable, Eurodollar, spot products. That's how intense the world of compliance and offboarding has become. And to some extent, you can't really blame global banks that have an emerging market footprint, but the bulk of their business is not emerging markets. It's just so simple for them to cut that sort of non-core business. One other area that we've definitely seen a growth in is on the private debt side. Again, really driven by clients, the investment-based clients whose mandates are changing. Finally, people have stopped convincing themselves that there is liquidity in emerging markets in bad times. So I think one thing that always frustrated me when I spent the first 10 years of my career, and I've been in emerging markets now 25 years in investment management, and I always used to call liquidity in EM debt the Kaiser Soze of liquidity. It doesn't really exist when you need it at all. And so end investors have been talking to the asset management firms about changing the mandates, and a number of mandates now include private debt investments. And that basically allows institutional investors to get paid for the illiquidity rather than pretending that they're buying something that they can sell when they need to. I mean, Mikhail, is that something that you've seen more demand of in recent months?
Well, obviously, as I mentioned before, we are in this very difficult, challenging time. So I would say that we do need some stability in the public market to see really this translate to private debt. But definitely, most of the institutional investors that we talk to have set up illiquid sort of private debt funds. So I think going forward, it is going to be a big thing. We just need to sort of paddle through the next sort of 3 or 6 months of this volatility that I do not think will subside super quickly, and then we'll get stronger on the other side.
And Adeja, something that you've pointed out before, not just in Nigeria, but also in the region, there's an increasing need for secured financing as well, specifically from regional banks, right?
Yes, I mean, I think part of the challenges of the past has been, I guess, the government wanting to remain in the driving force for a lot of the corporations locally. On the energy side of things, we're seeing changes in organization structure. Some of these entities now are looking to independently raise capital, and we expect to see that increase aggressively going forward, particularly in the energy space, oil and gas specifically, and we're hoping that can spread to other public entities as they move into privatization. That can only improve things on the capital market side in terms of diversity, as well as encouraging other private sector companies as well to seek out funding.
Yeah. And so I think right now, as Mikhail has alluded to, we're in an interesting situation where there's really a split between where institutional investors would like to invest and where borrowers would like to borrow. There's definitely a bit of sticker shock where borrowers are remembering where they managed to borrow last year and they'd love to do something similar and have not really looked at where US Treasury yields currently are. But certainly as we move into first quarter next year, we think that gap will start to narrow. But it really needs as well that help from the DFIs who can really bring in that anchor order, start to help to calm nerves with the institutional investors who fundamentally have $1.7 trillion worth of dedicated EM debt in their portfolios. And it's just unfortunate with timing with the interest rates rising that we have in G7. And that's caused this gap in what they want to see in their funding versus what the issuer want, plus driven by this dislocation in the secondary market, which again is a bit of a temporary phenomenon caused by liquidity issues. You often will have investors saying, but I want 15% because I can buy something in secondary at 15%, but the argument to that is if you want to put $50 million or $100 million to work, which is really the size some of the investors need to invest to move the needle on with their investment portfolios, you're not going to get it done at 15%. You might buy 1 or 2 million before you really start moving the market already. So you always start up with this negotiation, especially on the private debt side, between where the secondary market is in the public markets versus the private market. But that will start to narrow next year, and hopefully we should see an improvement in those funding gaps, I think. Otherwise, the bank syndicate market has been extremely active, and fundamentally it's just a matter of how much really dry powder there is and how much headroom for each individual name, because it tends to be the same names that come back again and again, both from a sovereign and a corporate point of view. So a bit more diversity from that point of view would be interesting. And just as a final point, something else that we're very encouraged by is that we actually see investors now in Africa coming from Latin America, for example. So we're seeing a lot more cross-pollination of emerging markets. We have Chilean pension funds. We've got Colombian asset managers buying African debt. And so, again, part of that is because of where can you invest money out of, in emerging markets, but out of LATAM space. If you look at the senior space, Russia's totally off the table. There's Ukraine obviously is difficult to invest in right now. Turkey, you've got the Erdogan put at all occasions. You just never know quite what he's going to do next. South Africa's done fantastically well really on the back of this, in that it's one of the biggest, most liquid markets in the region, as was Egypt up until relatively recently, where it's hit a bit of a rocky time. But that's really left this opportunity potentially for the whole rest of the continent. But I think we'll leave it here. So thank you very much for sticking with us and listening to us. Thank you.
Many thanks. Great. We're going to introduce our next panel now. So if you'd like to come up onto the stage and get yourselves mic'd up. Our next panel will be on private credit in Africa, the case for and against. Our moderator is Joe Mate, Investment Director of BII, which is British International Investment, formerly CDC. And he'll be joined by a number of panelists in the private equity space. Many thanks.